Look, with nearly 40% of the labor market involved in some sort of side hustle, the gig economy is in full swing. We've got day trader Uber drivers, Pokemon scalpers buying duplexes, TikTok dancers selling real estate, and Etsy moms who make more than middle managers. Millennials and Gen Z with Harvard MBAs are snatching up baby boomer owned businesses like it's Black Friday at Best Buy. But guess what? When it comes to getting a conventional mortgage, the banks are going to look at you like you're broke. You could be pulling in six figures with 5 different income streams and still get denied because you don't have a W-2 and a babysitter, a boss. But don't worry, in this episode, reluctantly joining me is Jason, co-founder of The Clear Close, and we're laying out the mortgage hacks for the hustle economy. From bank statement loans to 1099 only programs to asset depletion strategies, we're showing you how to get from gigs to keys. Hey, Jason.
Hey, Peter.
Hey, all right, before we start, we're going to do a little bit of an overview of the non-QM loan products on the market. And this is specifically geared towards, or this episode is specifically geared towards people who don't have W-2s, just traditional jobs, right?
Exactly. It's more so the people that don't fit into the conventional cookie cutter box, right? Or that mold. It's for self-employed and gig workers like you were talking about.
Right. And just to our listeners, there's no pressure to use our services. We are mortgage brokers and originators. We're here to provide free education and a little bit of entertainment. But if you do decide to ever purchase your home and you are in the gig economy, these products are here for you, and we can definitely help to get you into your first house, whether it's for your primary or for investment home. As always, there's a link in the show notes. So let's go on to the first segment, which is bank statement loans. Jason, what is a bank statement loan, and who is this best for?
When it comes to the bank statement loans, it's basically for self-employed business owners, right? So instead of traditionally with a conventional loan or a government like backed loan like a VA or FHA loan, we don't look at full tax returns to income qualify you. Bank statements are an alternative documentation method to qualify you for a similar mortgage. And basically what we look at in those types of scenarios are your the last 12 months of deposits as an example from your business, and then we average that to a monthly amount to qualify you for the loan.
Right. So you're not broke. You just have like a good CPA, right? So
exactly. So
on
it's
paper, you might.
Go ahead.
So on paper, you're not making a lot of money, but you actually, in real life, you are pulling in a significant amount of cash.
Exactly. So it's basically like Uncle Sam gives you the tax code, right? Or at least the IRS gives you a tax code on how to file your taxes as a business owner. It's not earned income where you're W-2. So CPAs, they get paid very well to understand the tax code and for business owners to minimize tax burden or tax liability. So CPA and taxes might say you're making less income versus your actual revenue and cash flow and what's coming into the bank is much higher. So the bank statement loan lets you qualify potentially for a more traditional, an alternative document mortgage versus a traditional mortgage where it'd be much harder or impossible to qualify.
So they're looking at bank statements. How far back do they go?
Typically, they look back anywhere between 12 to 24 months. So it's going to be, you have two choices. It can either be business for like your self-employed business bank statements, or it can be your personal bank statements. But again, you don't want to see any commingling of funds. So this is where it gets a little finicky. Just because you do look at personal bank statements in cases, you want to make sure it's clean. The moment you start commingling, that turns into a nightmare and potentially will disqualify you for this great loan.
So I think just because you have commingled in the past doesn't necessarily mean that you're locked out of this forever, right? As long as you can maintain a good separation for the 2 years, 3 years that they look into your bank accounts, you should be okay, right?
Typically
12 months. Okay. What about credit score? What do people need in order to qualify for a bank statement loan?
Typically, they start at about 660 and up. We do have lenders that do go down to as low as 620, but with a lower FICO score, that just limits how much equity you can tap into. But ideally, you get the best terms when you're at least 660 and above.
Nice. So you said it earlier, the biggest pitfall of these type of loans that will, derail your deal or delay it significantly is commingling of funds. So for everyone out there who has their own business or they have a 1099 or they're doing it through an LLC or something like that, keep your books clean. Business purchases on your business credit card, personal purchases on your personal credit card, and don't mix the two.
Exactly. Like you want to make it as simple as possible on yourself. Like I know it's convenient to have a single debit card, for example, have everything go in there and you just use that one card. You want to make
Hmm.
sure like to run a clean business and a growing business, you separate that. That way it gives you clarity as to what your business will generate and then it also gives the underwriter clarity.
And your CPA, make it less stressful on your CPA.
Exactly. Maybe he'll find you better tax liabilities to minimize, right? And then
Yeah.
the other thing too that I see a lot of pitfalls is people look at like the last couple months and think, okay, I had a really good last couple months, and then they assume that's going to be the average monthly income that they qualify for. But when it comes to the bank statement loans, we look at that 12-month period. So if it's
Right.
you have seasonalities and stuff like that, we want to be able to explain why in winter it's slower. You own a landscaping company. Well, it's a dead of winter in Michigan. There's no landscaping to be done, right? Explaining that story to and to your broker or loan officer is very important so that they know how to structure that to the underwriter as well. So they give you the most qualifying income.
Awesome. All right. Next, we got 1099 only programs. So how do these work?
Similar. It's basically if you're like a independent contractor, commission-based sales employee potentially, or like I think you said earlier, gig worker, like a Uber driver or DoorDash, right? You're gonna
Hmm.
get paid on 1099s each year instead of a W-2. And because you're not really self-employed in the same sense, um, it's based purely on your 1099. And then from there, there's no tax returns needed. And it's similar to how bank statement loans work. We're going to look at either a 12 to 24-month period to help figure out what your income looks like.
Okay, so a similar time period where lenders and underwriters will look at finances about 12 to 24 months.
Mm-hmm. Correct.
Okay, cool. What about requirements? What do people need in order to qualify in terms of score or anything else?
They're actually very similar. It's when it comes to non-QM lending,
Hmm.
it'll depend on the lender and the bank that you're technically using at the time because those guidelines will constantly change. So today I have options that go down to as low as 620, but as times get tougher or the economy becomes more uncertain, lenders will
Hmm.
start tightening up those guidelines. So I've seen it in the past where they tightened up with two easy levers for them. They'll either raise the minimum loan amount requirement or they'll change the credit score requirement. So that'll those two levers are very common. But right now, I can get a lot of people into these non-QM programs starting as low as 620. But again, you definitely want to talk to someone to get most accurate info when you're ready.
What is a potential pitfall here for 1099 loans?
Again, very important when you talk to your banker or a broker about these non-QM loans, especially 1099. You want to make sure that you explain your work the best. Because when it comes to businesses, underwriters will always be conservative. Even though this is an alternative document loan, it doesn't mean it's an easy loan. It's not. You non-QM is a non-qualified mortgage. I don't think we've talked about on previous podcasts is length of self-employment. If you're like newly
Mm,
in the business and you've got less than 2 years, sorry, almost every lender out there will not take these 1099s.
right. So you just want to be able to show consistency and predictability.
Correct. Always, always. When it comes to income, the underwriter wants to be able to confidently say, yes, I can give you this amount of dollars as your monthly qualifying income. So if they don't see stability in that business or believe in that business, that's going to be a challenge.
Nice. Can you tell me about the next product, which is P&L only loans? Isn't this kind of the same thing as a bank statement loan?
Yeah, so I mean, with P&L, it is kind of like a bank statement loan. Only difference is you're not exposing yourself to the underwriter with 12 to 24 months of bank statements. What the P&L loan does is it simplifies it where your CPA that's most likely filed your taxes for the last couple of years prepares the profit and loss statement that they sign and authorize and acknowledge that they've done your taxes for you and is your accountant, right, for your business. And they'll say, this is what your income is, this is what your expenses are. And from there, it'll explain to the underwriter what your true business profitability looks like, right? Whereas with a 24-month statement, it's just tons of paperwork. So if I had a recent client a couple months back where we tried to do the 24-month bank statement loan, it was absolutely insane because each of those statements were about 20 some pages long with hundreds of transactions. And we did that for 24 months. That ended up being like, I think it was like 400 and something pages worth of documentation, right? And his bank didn't, and the crazy thing is his bank didn't have PDFs because it was a credit union. So he literally had the banker print it out and then scan it. And we were just going through all of
Oh,
that paperwork. And like literally for that whole week, we were just going through like, we're missing page 12 of 15 on January 6th. We have 3 copies of whatever. It's like, it was just a lot of paperwork filing to organize, right?
yeah,
And
that sounds
then
fun.
it was incredible. It was incredible. It was a ton of fun. And then from there, figuring out how to make it all work, or figuring out that logistics of organizing, and then underwriter going through it to calculate it, and then it was at the end of the day, it was easier to just flip it to a profit and loss and have the CPA and accountant just say, this is what the income is, this is what the expenses are, and
Yeah, yeah.
they'll certify it, sign it off on it with their letterhead saying, I've been the CPA for this business now for the last 20 years, and we've seen this type of business, and they just explain it, right? And then that
Yeah,
makes it just so much simpler because profit and loss, we're basically
right.
looking at a year to date. And if the underwriter
hmm
has any more questions, we'll expand further and supplement it.
I remember when I was, previous job, they
Mhm.
did yearly audits, just because we had to submit it to the IRS, right? So if you're a sole prop and your organization is already doing some sort of audit, internal audit, or your CPA is preparing statements to send to the IRS, you can basically use the same thing, can't you?
Similar. It should be. If your accountant's doing it, it should be it should be what you're using.
Oh wait, this is for personal, not for business.
No, this is business. We only
Oh, this
lend
is business.
non-QM banks, just to be clear, non-QM bank statement loans, 1099s, P&L. These are all self-employed businesses. Like the ground rule, like you have to have 24 months of experience being a business owner, and we have to be able to document it. We're not going to ask for your tax returns to document it, but we're gonna have to prove that you've registered that business through like a DBA or LLC documentation or state filing for the corporation, that your business was founded on a specific date and it's been in business for 24 months, right?
Okay.
That is like that's basically a hard stop. You don't have that 24 months and you're under, and most lenders won't lend to you.
Oh, this is very similar to like a business loan.
It commercial business loan, yes.
Mm.
The same goes with
Okay.
conventional loans with self-employed business owners, FHA or VA loans. Like if you don't have 24 months of experience, you're not going to get that loan.
So what would you say like unalives this kind of deals? Because we can't say certain words on YouTube. So what derails this kind of a deal?
Basically, like you got to be truthful, right? It's you can't just say I make $1 million a year and your deposits don't show that, or your P&L doesn't support it for the type of business you're in. Like if you're a manufacturing company and you do 25 million in revenue a year, but your cost of goods sold are extremely high, then they're gonna account for that. How many employees do you have? Like, are you really a sole proprietor? Are you like you have to explain your business to the broker so that they understand how to explain it to the underwriter when they do your income review. Because once you open up, I've seen cases where someone told me they have 8 full-time employees, but when we look at the bank statements, there's like 32 people on payroll. You know?
Oh, it takes an experienced broker to catch those type of things because, as a borrower, you might think that this makes sense. This is how I explain it to the IRS, and I passed my audits before. But it might not pass when you try to get a P&L loan. So this is another, shameless plug. Jason and Nikki, you guys have done hundreds of these type of loans, right?
Exactly. So they're not the easiest loans, but they're also challenging in a way that they're fun for us because it's not the cookie cutter like ABC, move on to the next. It's literally, it gives us the opportunity to analyze and understand your business so that we can be
Mm-hmm.
partners. Because long term, if you were able to do it once before, there's still no guarantee that you're going to be able to do the same loan again later, unless that person that you're working with invests a lot of time to stay up to date with all the hundreds of different lenders out there. And for us, as an example, we're partnered with currently with over 155 different wholesale partners in this business. So we have options, and learning and staying on top of that is our job. So if you think one broker can do it, or they say no, or another says yes, again, you have to understand our business is constantly evolving because guidelines will change every couple months. And as markets and become more uncertain, what we're talking about today could be very different by the end of the year. And just like during the pandemic or post pandemic, we've
Or right
seen
now with tariffs, right?
with tariffs, right?
Yeah.
Exactly. It's like I've seen lenders, especially small and large, go belly up or even tighten up so tight now that they're just basically saying we're not going to lend in non-QM unless you're this specific client because we don't have an appetite for risk anymore. So I'm seeing
Hmm.
people like raise minimum loan amounts. Like some were doing maybe 50 to 100,000, and now other lenders are saying no, we can't do anything under 300,000, and we won't lend above 60%. So it's like basic math there. 60% of 300, your house has to be worth 500,000. So they're looking for a specific clientele now, and only
Right,
that one.
right. That's interesting. Raising the loan minimum, it uh, locks out a bunch of people who maybe um, wages or their income is not sufficient to afford that type of house, right? So that's how they're doing it.
That and they might not like certain market segments. So by
Mm-mm.
raising minimums to those levels, you're basically saying no to the Rust Belt, because
Mm.
those houses won't meet that minimum loan amount and loan to value threshold. So now they're
Interesting.
looking for
Yeah.
like what they consider to be more stable markets.
Or high net worth communities, right?
Correct.
Where it's a little bit more
Hmm.
stable, or it's gonna appreciate more
Exactly.
likely. Hmm.
Exactly. Or just
Oh,
ride through the storm more stably, right? Or
yeah,
in the
yeah.
sense, if I'm going to put $500,000 out there, I'm just thinking as an investor, if I'm going to put $500,000 loan out there, what's the likelihood of me getting repaid on that note?
Of course, that's
It's
all they think about.
business, right? It's
Yeah,
risk. It's risk mitigation.
right. Okay, what about borrowers with no job, but they have a lot of assets? So this could be a lot of the baby boomers. They're probably retired, sold their businesses. They're sitting on a lot of cash. Maybe they've paid off their home, right? Maybe they've paid off multiple homes.
Yeah. No, this if you're cash rich or not cash, if you're it's this is not for people that have a lot of equity in a home and just sitting there. This is money that you're gonna have access to through like liquid cash accounts, CMA, stock portfolio,
Okay,
things of that nature. We don't
liquid
asset
cash or
deplete
liquid. Hmm.
equity. Just to be clear, it's his
Oh, this
only
is.
bank asset,
Uh-huh.
market assets. So I mean, it's a common misconception Peter, when some people think I have a ton of equity, that's an asset, right? It is an asset in the sense that it's possibly a real estate part of your real estate portfolio, but it's not something you can quickly turn into cash without creating a taxable event or selling the property. So
Mm-hmm.
these asset depletion loans, to be clear, have a dollar value in the sense that they're in a CMA account, like a investment portfolio, liquid cash that you have in the bank, right? Or proceeds from another asset sale. But what I found was the simplest way to qualify with asset depletion, which I use a lot for retired folks or business owners that have a lot of money in the bank that they have access to. Well, as long as you have 125% of the loan amount. I've had clients where they had multiple homes already, liquidated properties, still have about 11 or 12 units under their belt, but they're sitting on about $1.5 million in cash. So they wanted to buy a house out here in Southern California for 1.1, and they were able to buy it with just that calculation alone.
This is kind of like margin lending on stocks.
Yeah, in a sense, it's the reverse of that. That's actually a good way to think about it, and also confuse a whole lot of people at the same time.
Oh, okay. We are not financial advisors.
Yeah, no, it's the margin lending, um, portfolio
It,
lending, different story, right? But asset depletion, purely in its simplest form, is you just literally have money sitting in the bank, and the lenders use that to determine what kind of income calculation can be derived from it, and and you just have an easy way to repay a loan. Like it's the simplest loan, and you actually get really good terms for it with a lot
what
less
hap
paperwork. Mm-hmm.
is there any restriction on like the bank sees 125% of liquid assets in some sort of account.
Mm-hmm.
Is there some sort of restriction from the bank or agreement that you sign that you're not going to touch those reserves or you're not going to liquidate
No,
it
they don't make you sign anything. They just look at your ability to repay. So like what they're gonna
in
do
that
in most
moment?
types of cases, they're gonna if you do asset depletion, this will vary by a lender, but
Hmm.
they want to see 4 months of seasoning of those funds conservatively.
Mm.
They want to see that that money has historically been sitting there and it hasn't just suddenly appeared within 2 months. Does that make sense? So they'll
Hmm.
conservatively they want to see like if you state you had $1 million today, was that $1 million there 4 months ago, or when did it
What
come
if
in?
I have $1 million in Bitcoin?
No, I there are lenders that dabbled in it. It's not impossible. I know there are lenders out there, but that's a very very big outlier. And from what I've seen, if they do count it, they look at it and treat it like an equity, which means if you were to liquidate that $1 million in Bitcoin and they were to give you that asset, they'll give you 70% of the market value. So if it's $1 million today, they'll give you $700,000 of asset that it'll qualify for. But that's also very tricky too, because a lot of banks and lenders are trying to avoid that still.
Yeah. 4 months of seasoning with Bitcoin or any crypto, that's asking a lot for it to stay stable.
Exactly. It's personally not my cup of tea. I did help someone with purchasing with some sort of form of crypto asset. It was an NFT a while ago, but
Oh, interesting.
that one it was interesting because we had to show where the initial money came from to buy it, to source
Oh,
that,
wow.
and
Yeah.
prove it, and then also at the time of sale of dispositioning that NFT, that asset, and that dollar, we had to backtrack all of that. I don't know if
Oh, wow.
and that was years ago, so I don't know how people look at it now, other than the fact that from what I understand, if a lender does still accept crypto, they're going to treat it like a stock. So it's going to be a percentage. Like if you were to sell that stock, we're going to give you, or to calculate the volatility, to not sell it, to give you a fair value, they're going to say it's going to be 70%. that's traditionally what we see with equities on the stock market. $1 million in stock portfolio in your CMA account will give you 700,000 in qualifying asset for asset depletion.
So you're gonna have to show more than 125% in stock value. You're gonna have
In
to
that
show
case,
like
yes,
yeah,
because
like
then
150 or
because
something
then
like that.
if you were trying to get $1 million loan and you had $1 million in stocks, underwriting would only give you 700,000, so you wouldn't have
Right.
enough.
Yeah.
It would then become like a hybrid loan where you would show any type of like earned income through like W-2s, 1099s. And that's the cool thing about these non-QM loans that we haven't touched on. They let you mix or quote unquote assist in qualifying. So say for example you had
That
bank
makes
statement
sense.
loan
Yeah.
and you qualified for $10,000 a month in income, but you needed a little bit more income, but you had $1 million in assets in the bank. So now that $1 million stock portfolio at $700,000 can be divided by 60 as an example and added to your bank statement income to help you qualify. So
That makes sense. Yeah.
So it's like creative lending, and you need someone very experienced to understand the different intricacies behind it.
And there's one more that we haven't touched on in this video, DSCR. But we have talked about DSCR loans in previous videos, so I'm gonna link. I always forget. It's here
It's
or
one of
here.
these, one here.
Yeah.
But yeah.
But real quickly, Jason, what's a DSCR loan?
Quick and easy for DSCR is basically you have a rental property. It's just only for rental properties where it generates a certain amount of income. And as long as that income can pay the principal, interest, taxes, and insurance and service that debt liability for the mortgage, that's how you qualify. And it keeps it very simple.
Awesome. So if you want to see any, I'm sorry. So if you want to see a deeper like breakdown of DSCR loans, there's gonna be a link here or here. I forget which one. Okay, so Jason, do you have any closing thoughts?
A lot. So there's a lot of information on non-QM loans, bank statement, profit and loss, 1099, DSCR. It's just so much information. You have to do your research because just because you hear it once from somewhere a year ago, 2 years ago, 3 months ago, right? Or from a broker A, B, or C, you have it. This part of the business is always changing. There's a constant evolution. So it may have worked for you 6 months ago, but it may not today. And before you go down that path of trying to buy another home, you have to make sure you shop and understand your pre-approval, pre-qualification, because these are going to be very important over this next year with all the uncertainty of the market and changes. So it's do your due diligence, talk to people, bankers, brokers, even if it's not myself or Nikki or Peter, get multiple opinions on your scenario and goal, because I can guarantee you if I have over 150 different lender choices out there, there's thousands across the country. So, and we always constantly filtering. So if we're at 155 approved brokers that we were, not brokers, 155 wholesale partners we work with, we keep them accountable because we have that kind of volume. So doing that research on your end or working with brokers that understand this business and not do it part-time, that's going to be key. It's easy for me to pick up the pieces. It's just stressful for all of us if we're trying to do it in 5 days,
Yeah. All right. That's it for today. Make sure you click the link in the show notes to get your pre-approval for your next non-QM alternative income loan. And we hope you guys got a lot out of this and maybe even inspired you to start your journey into home ownership or real estate investment even. So if you want to see more content like this, give us a like, a sub, and comment below. It really helps us out. It doesn't cost you anything, and it means a lot. We'll see you guys in the next one. Bye.